After yesterday's moves in the commodity markets, I think it deserves an update. And the key levels that I was looking at, the 20-day average for the dollar and the supports for gold and silver essentially broke. And so we look at what alternate possibilities are there. Now, much does not change for the dollar's broad decline, which means what we are looking at is this is 1 and 2. And all we are at is waves 3 and 4, and we are seeing this minor ABC, which looked complete in the euro, which is why I thought we were done. But in the dollar index, it's actually continued, and I guess now we are in that fourth wave. But note, the second wave was a 61% retracement of wave 1, and so when we are looking at the fourth wave, it's essentially would expect a 38%, which is not far up, very close to the 40-day average, near around 90.6. And even if it overshoots to 50%, which is rare, it will do 91.2, and after that you would be heading down again. So we are looking at something like this, and then the start of the fifth wave. And the fifth wave would then have to achieve all the targets set out at the broader level, which I discussed, which is if you're equal in size to the first major dip that we did. And so I'm doing all these markings all over again to show you the picture. Then if you're looking at the third wave, it's equal to the first, not extended even, we would be going down to 83.2 in this move. So the upside, even after yesterday's move, is very little, and the downside is a lot more. Still, we've seen a pretty sharp reaction in the metals markets, both the base metals and precious metals yesterday, which can be a bit surprising. But I wonder, and there's always this question as to what plays more important role in the move for these markets. Should it be bonds, or should it be the dollar? And in the 1987 comparison, which I showed in a previous video, and the note I wrote over the Sunday weekend, the bonds essentially at that time when they were crashing and the dollar was also falling, and equities went up till they eventually rolled over. What did gold do in that time frame? It actually moved up, which means it paid more respect to the dollar than to the bond market. But I found in the last couple of years, many times when bond markets are falling and yields are spiking up, that gold and silver essentially do come under pressure. So the question always is, which one is it going to play out to? And so far, the precious metals were holding out against this route in the bond market for the last several months, though you can say they were down into December, which was the seasonal trend, and they rallied from there pretty strongly over the last month, so that was a good sign. So why did they then sell off in the last couple of days? Apart from maybe this bounce back in the dollar, there shouldn't be any other reason. Still, I discussed this alternate more than a week back that there could be a wave E case. I'm not yet giving that maximum preference, but it is an alternate. If all markets end up responding a lot to what is happening in the bond market, then maybe that takes precedence over what is happening to the dollar in the near term. But the falling dollar essentially leads to selling in all dollar assets. Now, all dollar assets means equities, bonds, and it can mean commodities as well in the near term. But eventually the falling dollar will probably take over on those trends. So what you need to look out for is the potential for short-term or medium-term corrections in what is a longer-term trend. But the dollar upside, like I said, is going to be limited. So anything that happens in any of those other markets will be their own trend, standalone, and they may deviate from what the dollar is doing short-term. And so keep that in mind. In that, I'll just take the example of zinc. I covered several commodities over the last 2 weeks with both the upside and downside. The upside, I said, they're starting a third wave, they could go to the upper end of their channels. At the same time, I showed weekly charts, I think in a couple of base metals, including lead, and this one is zinc, where on weekly charts you had this momentum divergence, which means prices were at the upper end of upper Bollinger Band, and the momentum indicator was actually still in sell mode, and then it went into a buy mode, but now it's flipping back. Now you'll have to actually wait till Friday's close and see if it goes back into sell mode. And if that happens, you have something like this, where you get a false signal near the upper band, and then you get a much deeper correction. So that's the risk we are seeing with these base metals. It need not be the case, but it's a potential risk if we get a further confirmation. Here too, the 20-week average has held well in most extended rally. So despite all these buy sell signals here in the momentum, the 20-week average held on and the rally just continued. We saw that happen in here in December. We did fall below the 20-week average for a week, but went above it, and the rally just continued. But now that you have this divergence, the question is: are you hooking up for a deeper retracement, maybe back to the 40-week average before the rally can continue? So that's what we need to watch out for if all markets go into a twist. And we've seen this also happen in say lead. So I wrote some time back that it's holding the 20-day MA, and as long as it is, maybe the upside case is on. But it's been whipsawing. You see these buy sell signals. So it's holding the 20-day MA till yesterday. It actually broke below that. And here too, the same case. This is the weekly momentum on top. And in this weekly momentum, if we stay down like we have, we'll probably break the 20-week average here at 162.40. And if this goes into sell, it means you're looking at a deeper correction, which means you'll test the 40-week, or maybe you'll do a deeper retracement before we can get an up move again. So this is, I think, the risk. We saw something of that kind here. This hook, which occurred, prices moved to the upper band, and then they sold off in a slightly deeper correction. So we're seeing that kind of a hook again, possibly developing on the weekly chart. Confirmation to be seen by Friday. But this break on the daily side, which means this rise is looking very, very corrective right now, means that the potential for this now is pretty high. And so most base metals now are reacting to what is their weekly indicators, or higher time frame indicators, which were diverging rather than the short term trends which were building up. And so the weakness in equities and bonds is spreading to all the other asset markets quietly. It didn't do so far, and so you would have wondered whether they're going to hold out. And I thought so too, because the dollar is falling and commodities are holding out against equities. It's possible, but the sell-off in the bond market, which is causing higher yield expectations, is probably acting as a strong pressure point. Though it's possible yields cool off a bit for a while, like I said, but that doesn't mean they'll go too far down. Maybe they go back to 2.7, 2.6. But once again, you want to go back to 3% on the 10-year US. And so that pressure will keep coming back every time. So what can it mean for the gold market? Now, I've drawn this head and shoulders pattern from this. This is the fourth wave of this wedge down to this high, and that's how you get a neckline. The neckline for an inverted head and shoulders pattern is what we touched and sold off. So we didn't get a breakout. On the other hand, I'd been looking at this triangle for several months, and I thought in December you touch the lower end at 1200 and then take off. But once you got this three-wave decline here, this A, B, C, I thought maybe it's a truncated low point. It does happen sometimes, and then the market just takes off. Now, the only reason we are falling here, and note this rise is an impulse, so there's no doubt about this being an impulse. The only question is this wave 1, in which case we are in wave 2, and wave 2 can keep retracing, and as long as you don't really break this low, it can still be wave 2, and you can still get that big runaway once this correction is complete, which might only be happening because of the dollar. And in that sense, gold can still deviate from the rest of the market and do its own thing. The only thing is it needs to complete this correction, and you need to get. So this should be the first primary expectation, that we are just doing wave 2. The retracement didn't stop at $13, $17, and if we are breaking the 40-day average, which I discussed yesterday, then maybe you get a deeper retracement, but it doesn't change the bigger picture. Now, this 5-wave rise can alternately be thought as part of this whole complex correction, which means if I consider this as W, X, and then I take this as a 335 Y. Okay, a 335 being marked as A, B, and this C. Where C is a 5-wave pattern. C is always 5 waves in any corrective structure, and so this 5-wave rise instead of 1 is C. That would allow us one last sense that in the larger triangle that I've been marking, which means this wedge A, B, C, D, which I thought would have occurred at this September high, is here, and we are now getting E, which goes back to test the lower end of the triangle, which is closer to 1225. I don't see that deep a cut, but if this retracement is deep enough, even if it's a higher bottom, it may come close to touching this lower line, and maybe you can say that E only ended here, even if it's just 1250 or so. So if you reach 1250, should you consider this as a truncated E instead of the December low? Possibly yes. Most of these rallies, like I saw, this bottom was in December, this bottom was in December. So I didn't expect us to be selling off after we made this December low and rallied so strongly. But we have seen March lows. For example, I think this is a July low. Here we did see a November, December low, and then later a March low. So after this rally, which went into late Jan, we sold off into March, and then saw a pause. So March is, so you notice that December and March, these are seasonal dates where you get a top or a bottom. Typically a rally that starts in December, goes into March, then peaks in March, and you get some kind of a correction. But if you have already paused, maybe we get a bottom in March, which means that into the Fed meet, which is the interest rate hike, which is so much expected next month, maybe that's the point at which you will get this low point, because each of these low points, note, this is an interest rate hike, this is an interest rate hike, this is an interest rate hike, and seasonally they were in December, but we can also think of something happening in March. So we did have a 10th March low here, but this was an intermittent low within this entire cycle. So that's what I'm looking at, whether this is just an intermittent low, wave 2 goes up, or is it going to be wave E and then goes up sometime into March now, because we've already peaked and did not hold the key supports near the 13-15 odd range, and are probably breaking down from there today. Because I think the live price currently that I'm seeing is 1313, which means we are well below the 40-day. So this is what we'll expect over the next 1 month. It does not change the big picture whether we do E or we do 2 after this deeper cut that we are looking at. E should eventually, the next move up should be a breakout from this inverted head and shoulders pattern in the second half of this year. So we continue to remain prepared or preparing for that big opportunity that lies ahead. So very something similar that you would expect from silver as well. Very similar chart. You draw the trend line of the highs and lows. I've already considered that within this triangular pattern, this is A, B, and then we're looking at C, D, and E. So essentially I looked at D occurring at this high and in September, and that E would have truncated here because this was an A, B, and C decline. And the alternate, like I discussed in gold, is that this is 335, this is an ABC structure, and D only ends at this high. And in this rare case, because silver has actually fallen below the 61% mark. Now again, I might add that if it doesn't break this low, this can still be wave 2, just like in gold, but if it does take a very deep retracement, you may mention that this is a wave E as well, and the actual move only starts later, either from a higher bottom or maybe actually touching this line this time around. And this lower line is at around 15.48 odd. So once this dip is done, probably into the March cycle, we should then again expect April to May or June, the big rally, breakout rally to resume. And this time around, I guess we should get past this triangular pattern and break out beyond the $17.4, $17.5 mark. But same pattern in both gold and silver, a down move into March, and depending on the type of move, I think we'll mark it as 2 or most probably E, and then look for the breakout move on the upside. Before I leave, why not even consider the US Dow Jones chart on the hourly? I have been showing for the last couple of days that this can be a 5-wave decline, and in that sense we've already seen waves A, B, and C complete over here, and that means that we may be very, very ripe for this move to start down again. But I also mentioned that on the daily chart, because we didn't see this 4th wave, we didn't actually close positive out here, we just have this whole fall as one single decline on the daily chart. This retracement, this ABC, did not reach 61% of the entire fall, but it did reach 61% of the fall from point 2. Now, can it be a 4th wave? Typically, because the 2nd wave was also a good retracement, the 3rd wave would 4th wave would usually do an alternation, which means you would expect the 38% kind of retracement, but this is actually 61%. So it's possible that this is a 4th wave, because the 2nd wave here did a smaller retracement. It didn't do 61%, it did 50% on the Dow, or probably within 38% on the S&P. And the 4th wave has actually been bigger, where you've done 61%. So this is also a possibility. There is 1, 2, 3, 4, and actually just starting the 5th down, which might test this low, maybe even break it. and only after that you'll get a more meaningful retracement of the entire decline. So this is an alternate to actually keep in mind as possible. On the early charts, though, it was possible to mark this entire fall as 5, and so I did consider it. And in that case, then this is second, and we're just starting the third down. Now we'll continue to monitor these both alternates, but the key thing I wanted to mention is this A, B, and C is complete, and we did close down on the Dow and Nasdaq and various US indices, which means that the next leg down may have already started.